All right, welcome to the Voices of Wall Street. I have a very special guest. We got a very special guest joining us today, Darius Dale. He is the managing director and partner at Hedgeye. Darius, thanks so much for being with us.
Yeah, appreciate you, Dion. How you doing, man?
I'm doing well, man. I'm doing well, and it's no overstatement to say that you are kind of the perfect guest to have on the program with us today. So I'm really excited to pick your brain a little bit about the current status of everything going on in the markets and all of that. Let's just get it started here. I mean, you have to have been watching what's going on with GameStop and AMC and kind of these blasts from the past names from the 2000s and the 90s that have just been going on crazy runs. Just right out of the gate, what's your thought about what we're seeing in the markets here?
Yeah, man. Obviously, there's a lot going on. I haven't been able to shave or shower in the last 24 hours. So
you look pretty clean. You look pretty clean, yeah, man, for not having shaven.
I'm a handsome guy. Just joking. Anyway, so let's break this down by its component parts, right? So I think you need to know where you've been, understand where you are, and where you're headed. We have a regime-based framework at Hedgeye here. To dictate and identify and communicate what the macro investing regime is. And it became pretty clear to us, back in the early part of November, that we were transitioning to what we call Quad 2. Quad 2 is where growth is accelerating and inflation is accelerating at the same time. And so, what that means is that, you typically have bond yields going up, the dollar going up, but within the equity market, because obviously that's positive for stocks, within the equity market, something very interesting would happen in terms of coming from what we had been a Quad 3 regime into a Quad 2 regime, and that's where you have to cover your small cap shorts, cover your high beta shorts, cover your levered shorts, and actually get long of those types of exposures. So that's what we did. That's what Hedgeye clients and subscribers did back in mid-November. And obviously, a lot of these hedge funds, I don't want to name names, but they just didn't get the message. They came into the year ill position for what had been a couple of months of trending Quad 2. And so obviously you got the Wall Street bets community, they could see this and they could pounce on it. In fact, I would argue they're doing the same thing that a couple of these hedge funds are actually known for, which is, forcing people out of crowded trades. So, maybe they're getting a little bit of their medicine, but, hey, we all take our lumps, we all learn from our mistakes and, knock on wood, we just get up and keep going.
So I think that brings me to the next question is, where are we going? Because, as you said, a lot of hedge funds have taken their lumps, but I had a talk yesterday with Ihor Dorsanowski of S3 Partners. He says the hedge funds, the institutional investors, they're not backing out of shorts. And a lot of people are calling what's happening in GameStop a short squeeze, but he says very decisively, this is not a short squeeze. The shorts are not squeezing out. Anytime shorts fall out of the trade, new investors are coming in to continue to short those stocks, and the short squeeze hasn't even begun in GameStop.
Yeah, I mean, I would disagree that it hasn't begun. I mean, obviously, you got some pretty noteworthy hedge funds, kind of on their knees in terms of having to, take on some injections of liquidity. It's definitely begun, but I think the bigger picture of what you're trying to get at is are we in the latter stages of this market phenomenon, this event? We would tend to think we are. For a variety of reasons. I think the most important reason is that you've actually seen a tremendous amount of degrossing by hedge funds, and I'll take a second to explain that. Hedge funds, many of the ones where they're kind of in the news over the last couple of days, they run levered portfolios, so they have
Right.
more money invested than their actual base of capital. Sometimes 2 times, 3 times levered, 4, 5, 6. Some go 8, 9, 10 times levered.
Sometimes 10.
Exactly. And so effectively what they've done is they've taken down their leverage. So they're shrinking their long book by selling winners. That's why you saw a lot of high-flying tech stocks down yesterday. But they're also covering shorts. So, that creates buying pressure on the short side of, some of these high beta consumer cyclicals that, these were just latent exposures that they should not have had, dating back to November. So, they degrow. So they took down their leverage and their exposure to the overall asset markets down by down at the fastest rate. And again, I'm citing prime broker data. We don't run a prime brokerage, so I kind of just see these headlines on Bloomberg and Twitter. But they degrossed, so shrinking their leverage by the fastest rate since October of 2014. Well, you go back to October 2014, I remember myself, I was kind of just really starting to trade my own PA back then. And, I remember being super scared and freaked out, and market went literally vertically down on that Ebola news. But that was actually a buy signal. It was a buy opportunity. When everyone shrinks and degrosses and panics and rushes to buy protection, just like we saw yesterday with the VIX exploding to the upside, the volatility of the VVIX index was exploding to the upside, biggest one-day move since Volmageddon back in February 18. That's indicative of an emotional puke, a fear factor. And what you want to do as an investor is come into today's like yesterday with a little bit of cash, and you can accumulate exposures to position yourself appropriately for the forward outlook for the markets and the economy. And we continue to be quite positive on both.
Okay. Let me just ask you really quick, what makes you so positive? You talked about that we're in the second quarter now, or the second, I forget the term you use for it, but we're in the second stage. What makes you so positive?
Yeah, so quite positive. I mean, one, we're going into an environment in the first half of this year, just primarily due to base effects alone, but you can also layer on vaccinations and incremental fiscal stimulus out of some very major economies, including our own, that we're going to have a state where 91% of the economies in the world, and we model 50 different countries, with our quantitative systems, 91% of the economies in the world are going to be in Quad 2. That's very positive. In Q1, in Q2, that number jumps up to 98%. So there's just not going to be a lot of stuff to short. And so ultimately what that means is that, bond yields are going to continue rising, the dollar's going to continue falling, and it's likely to continue to break volatility down on a trending basis. This latest move notwithstanding. So, again, we think it's a buying opportunity. Just looking at the U.S. economy specifically, I just refreshed our model after the Q4 GDP data this morning. We have the U.S. economy going from down 2.46% on a year-over-year basis in Q4. That number was just reported, accelerating all the way up to plus 10 by Q2. So that's a pretty meaningful acceleration. Nobody investing in Wall Street has ever seen such an acceleration. You have to go all the way back to coming out of World War II to see that kind of delta on growth. So the reality is I don't think investors really understand what that could actually do to earnings and to cash flows for a lot of these B-leaguer companies. No one's been able to model this. We haven't seen these data, these types of moves in the data set. I think there's a lot of potential for upside surprise on earnings and cash flows as we progress throughout the first half of the year.
I think the other thing that's interesting, though, is that haven't we seen the market decouple from economic fundamentals? I mean, you talk about potential for a 10% growth quarter, which is substantial. But we also just saw the U.S. economy shrink. I think it was 4.2% last year, or sorry, 3.5% last year, while the NASDAQ, I think, was up 45% for the year, and the S&P 500 up, 20-30% for the year. So how do you square that, right? I mean, it follows logic to think, okay, the U.S. economy will grow, so the stock market should grow, but that hasn't been the case even the past few years. Growth in the economy and growth in the stock market have not really worked together.
Yeah, so I think I would push back on that and respectfully disagree. When you analyze the economy in rate of change terms, i.e., is growth accelerating or decelerating, when you actually look at it and model it on that basis, there is no disconnect between the stock market and the economy. The stock market crashed 30-something% when it was very clear that the economy and on growth and inflation terms were slowing precipitously in that lockdown period. And stocks bottomed into what had been the biggest acceleration in GDP growth ever into Q3 and into Q4 of last year. So you have to sort of sequence where the returns are actually being generated and what deltas the market's pricing in. So, again, if you believe that, like we do, that we're ready to change folks, that the markets care about, the forward outlook and how that's changing, that's prospect theory, that's Dan Kahneman, that's Amos Tversky. If you believe that's how markets function as we do, then you would say, hey, the forward outlook is quite positive. Now, I will say this: a lot of it's obviously been priced in since going back to November. So, I think as macro risk managers, the most important thing we can do is really sequence when the likelihood of that trending quad 2 move starts to dissipate and materialize into something else. And unfortunately for a lot of investors, that something else is going to be quad 4 as it relates to our regime-based framework. Quad 4 is that's where both growth and inflation are slowing. and that's the only quad in which equity and credit markets tend to have negative excess returns, relative to things like the dollar, gold, treasury bonds. So we don't think we're there yet. We think that a crescendo is inevitably coming sometime in the mid to late spring, likely on the heels of vaccinations rolling out, money coming out of the stock market and back into the real economy. And oh, by the way, you have this guy Jay Powell who nervously answered a bunch of questions yesterday on financial stability. I think we could be in a much more financially unstable place, by the time April, May rolls around, particularly if we get fiscal stimulus. So, we're dip buyers until something changes in our vol-based framework. I take notes every single day, and you see that highlighted. It says Quad 2 is still the most likely outcome according to asset markets. And so until that changes, we're going to continue to anchor on our forecast.
So Darius, let me pull on that string a little bit. I mean, you watched Powell's press conference yesterday like I did. I just was amazed at how he's really dug in on this theme that, the Fed's not doing anything. The Fed's not responsible for wealth and income inequality. The Fed's not responsible for asset bubbles in the market. The Fed's not responsible for, the housing market going crazy. None of that is happening because of anything having to do with the Fed. It's all everything else. Pay no attention to the man behind the curtain there. What was your thoughts?
The podium.
the man behind the podium, right? What were your thoughts about just the press conference yesterday and kind of this outlook that Powell provided that the Fed is not to blame or to give credit for any of these developments?
Yeah, no, that's a tried and true. There's a lot of tradition in Fed heads really ignoring the secondary impacts of their policies on promoting things like inequality and instability in both the markets and the economy. I do think that part of it is sad and unfortunate, because I think if he were more honest about it, it would spark a bigger dialogue about how can we actually start to attack some of these discrepancies that the legacy, the past bubbles of Federal Reserve policies have created, and how can we use macroprudential policy to really address those things, as opposed to blunt instruments like asset purchases, expanding the balance sheet, the policy rate, et cetera. I do think where we're going with this over the long term, because again, I will say Powell's tone is very different than a lot of previous Fed heads, with maybe the exception of Janet Yellen. Powell, I think, behind closed doors, you can sort of see it in his body language when he's answering these questions. I think he realizes that the Fed has contributed to a lot of the income and wealth inequality in this country that is obviously contributing to a very, very unstable, politically sort of disadvantageous fourth turning mood with respect to my colleague Neil Howe in that framework. So, I think they're coming down the pike over the long term. We really believe that this Federal Reserve, led by Jay Powell and potentially Lal Brainerd or a woman like Stephanie Kelton after him, they're going in the direction of actually directly implementing policies that can, from a macroprudential perspective, can really address that. But for now, I think Powell knows he's stuck between a rock and a hard place, because on one hand, if you tighten policy to take some froth out of the markets, that will create a headwind for the labor market from a corporate credit issuance perspective. But on the other hand, all we're doing is setting up for a bigger bubble to pop later on down the road, and ultimately we think inflation and the return of wage inflation and how that might impact corporate profits might become a bigger narrative alongside taxes and regulatory policy. But for now, we're still very bullish. There's no reason to get off the train, but ultimately we're going to have to make a pivot as investors.
All right, so I got one final question for you. Before we get to that, I got to go real quick back to something you said. Stephanie Kelton is Fed chair?
Yeah, I mean, look, she's kind of leading the charge on, modern monetary theory, which we're, from a de facto perspective, we are implementing modern monetary theory in a very, very poor manner with respect to how she outlines it in her book, The Deficit Myth. But we are doing it. I mean, the Fed's balance sheet on a 12-month nominal change basis is almost equivalent to the 12-month nominal change of the federal budget deficit. So we are monetizing the U.S. balance.
Absolutely. But President Biden, you think, really put someone like a Stephanie Kelton in there, or at least attempts to? Because I personally don't know how she gets confirmed.
President Trump put a private equity guy, a private equity millionaire up there.
Private equity.
where we're going with this, and I don't want to be dismissive of Jay Powell. I honestly do believe in his heart of hearts he wants to do something about the bubbles and the inequality that the Fed has created. I've spent most of my career attacking the Fed on Twitter about the inequality gap that they've perpetuated that my own family has obviously dealt with. And so I think they're listening. I think Fed Listens was a real deliberate attempt at trying to figure out how they can actually address some of the issues that they've created in our economy and our society. But until we get to that point, I think anything is possible. I think what we learned yesterday with this GameStop thing and this whole retail short squeeze, retail versus Wall Street, is anything is possible in the fourth term. The battle lines are being drawn. It's populism, it's socialism, it's anything but the middle and the establishment. Because what we are learning as we go along, that particularly this pandemic, it really accelerated a lot of what was happening and bubbling underneath the hood, which is that the establishment is not working for the broadest amount of people. It's working for an increasingly narrower and narrower subset of people. And I would argue you're starting to see hedge fund managers fall out of that as of yesterday. So it's going to get to the point where no one's really winning but a select few, and ultimately that's going to be extremely dangerous.
I want to ask you one last question before you take off, and that's, we heard from the SEC, we heard from the Treasury Department, Fed Chair Powell was asked about this GameStop phenomenon at his press conference, or at the Fed's press conference yesterday. Do you think we're going to see some regulatory action out of this? Do you think we're going to see some rule changes based on what's happening in the market right now?
Yeah, I don't know if it matters what I think on whether or not we're going to get it. But what I think, if we do get it, we're going to have a full-fledged revolt on our hands. You think about a lot of the people who are participating in these short squeezes. These are people who've been told their entire lives that Wall Street is smarter than you. People like me can just pick stocks or pick factors at a higher rate than they can in terms of success. And moreover, a lot of these people, particularly the millennial component of this community, they've grown up in an era where they've watched their parents get houses foreclosed on. They've watched the cost of living rise and not get counted in CPI. If you look at tuition, you look at healthcare expenditures, you look at their parents median income hasn't gone anywhere in a long time. I think a lot of people are just frustrated with this system that's not working for a lot of people. So any opportunity people have to get back at the establishment, whether it you go back to the events of early January in D.C., obviously there's going to be other things like it. People are taking the opportunity to revolt and really stick it to the establishment. So ultimately, I think where all this is going is if they regulate this, because again, what these retail investors, what they've done is effectively they're doing to these hedge funds what these hedge funds have been known to do to each other for years. I'm not naming names because I have a lot of respect for some of the funds and fund managers that are involved in this, but we've all heard of stories of people getting squeezed out of shorts by some people who had more capital. And this is what happens on Wall Street. So at the end of the day, hopefully the guys and gals involved learn their lesson. I hope the regulators don't overreact to this because again, I think it's likely to spark a real bigger revolt, a real bigger exodus out of the formalized financial services community and into more sort of disintermediated, places like cryptocurrency, like this type of stuff you see here. Because one thing what's very clear to me, and I'll end on this, the democratization of information that is the internet is and will continuously always be revolutionary. These people are organizing themselves in chat rooms, on Reddit, wherever you want to call it, and they're actually getting to sophisticated answers in a way that you used to actually need a Bloomberg and a couple of really smart analysts with CFAs and MBAs to get to that same conclusion. And they actually have the ability now with the information that's out there on the internet for free on Twitter, for not free from places like ours, they could get to the answers just as fast, if not faster, than a lot of the hedge fund guys and that are involved in this. So ultimately, I think it's an exercise in humility for people in the industry. I include myself as part of that discussion. We need to be cognizant and respectful of the amount of capital that this community of investors has when they decide to band together and really fight for themselves.
All right, Darius Dale, thank you so much for being with us.
Yeah, appreciate you, bro. Thank you.